prices still in record territory. The Nikkei marks its 12th day in the red.
Here in Europe, shares in UBS get a boost after it tells the market its second quarter earnings will be at or slightly below break-even, adding it has no need to raise new equity. Hello and welcome to CNBC's Worldwide Exchange. No Brian today, of course, because the United States have a holiday. I just can't quite remember what it's for. It is the Independence July 4th holiday. Here in Europe, meanwhile, and on the global equity scenes, a little bit quieter, as you might expect, with volumes a little bit lower. But the FTSE CNBC Global 300 down 9 points. Still plenty of news, though, and things going on that we need to be aware of. FTSE 100 off 0.8%, Xetra DAX, CAC Corona down. We've seen energy stocks sold off, but banks again today are getting a bit of a boost, none more so than UBS. Opened up around 8%, still up about 2.6% today after it said that it would only post a small quarterly loss. And banks actually in the last few sessions have tried to bounce off what have been pretty deep lows. So that's what's happening as best of the gainers. You've got Nokia and Lloyds TSB and Credit Suisse also not doing too badly. As far as the currency markets are concerned right now, the dollar's steady today, keeping most of the gains it made against the euro yesterday after the payrolls data came in close to expectations and eased some fears as well about the health of the US jobs market. Dollar yen 106.71, euro dollar back down to 157. Remember, this time yesterday we were around 158.70. Sterling hasn't done an awful lot, actually. We went weaker yesterday, really, on sterling dollar after the services PMI number, and dollar Swiss franc just back above 102.40. More, it's just the two of us.
There's a song there, right, Ross?
Yeah.
You know that one?
I do know that one.
You're not going to sing it?
You know I know that one.
All right, well, listen, I'm going to speak out for my pal Brian here. I know there's a hard war for you guys to have lost there, Brian. Ross, I mean, but I know Brian's out there enjoying a nice big barbecue somewhere. Have another hot dog for us, Brian. Listen, a lot of negativity here at the end of the week in the Asian markets today. We saw the Nikkei. Believe it or not, it is now 12 straight days of declines for the Nikkei 225. We've stopped counting how many years it's been since the Nikkei was on this long losing streak. Closing down at 13,237. We saw the Hang Seng and Australia managing to close higher today. The Hang Seng up by 0.8%, but Shanghai and South Korea both were lower today. One big reason, oil prices. That's been a big inflation fear for the markets this entire week. Today we saw NYMEX light sweet crude above the 145 level, still 145 and 65. And traders don't expect any big moves with that holiday in the U.S. Brent crude right now trading at about $146.90. So let's find out what all this means for your investment strategy right now. Greg Smith is Managing Director at Fat Profits. Nico Harajji is the CEO of N1 Asset Management. Gentlemen, thank you both for joining us today on Worldwide Exchange. Nico, let me throw the first question out to you. As we see oil prices hitting a new record in 5 of the last trading sessions, that has had a big impact on the Asian markets here. Do you continue to see oil being the #1, or at least inflation being the #1 concern for investors?
Well, first of all, it's great to be back, even on this Independence Day, which we don't really feel a lot of in Hong Kong. Going back to the commodities theme, or even the oil, and we are seeing, you know, prices that we probably never have dreamed about in the past 10 years. I think that oil, you know, if you go back to the Asian market, it's not only going to, you know, reflect the downtrend in the equity markets in Asia. I think it's a global theme. If we look at and also the oil prices, we think that too many traders, too many hedge fund managers, and this is something that I would like to emphasize is that the great hedge fund managers of this century are going to keep driving prices up. And I do think that not only that oil is the main driver for lower equity prices across Asia, I think that it's the sentiment, and I think that the capability for hedge fund managers actually to go out and shorten the market. So taking a lot of global macro factors into account, also oil factor, we still believe that there's a negative trend for Asian equities.
And Greg, do you agree with Nico in that oil and inflation are the two biggest factors weighing on the global markets right now?
Certainly it remains so at the moment, and it's interesting. Last week, I guess it was all about the inflationary story. This week it seems to be more about who's to blame, and I guess the new terrorist is the speculator. You know, and we've heard figures as much as 30, 40, 50, even 50% of the oil prices down to the speculator. From our point of view, last time we checked, the planet is still consuming oil at a rapid rate and continues to do so. So I think, whilst there may be some speculative element in the oil price at the moment, I think the underlying demand-supply story is going to continue to drive prices higher. Admittedly, we have had quite a sharp run-up in the oil price, and I think that's probably exceeded even the most bullish of pundits' expectations. Ourselves, we were predicting around 125 for the year, but we certainly see oil strength continuing for the rest of 2008. And clearly,
what are the implications, Greg, of that if you're invested in equities and bonds?
Well, I think with respect to equities, I think it's really all about selectivity. I think the energy sector constituents will continue to do well. Those sectors which rely where oil is a key input. I guess airlines is the most obvious. Are probably best avoided, particularly as their hedges expire. But also, obviously, it's about the whole inflationary story, really, isn't it? And taking a wider perspective, people are going to start feeling the pinch even more so as inflation bites, and I think that also bodes ill for the discretionary retail sector. We've seen no more evidence than that than Marks and Spencer this week.
Niku, if oil prices are hit this level, are here to stay, or they keep going high, if you believe Greg, that puts more pressure, more inflationary pressure onto emerging markets in Asia, emerging economies in Asia. What happens there?
Well, first of all, I do agree with Greg that the oil prices are here to stay, both in terms of demand and supply, both in terms of geopolitical tensions, and also because I think that the traders or investors are playing the inflation game by buying oil. Long term, how it's gonna, I mean, obviously, if we see the growth in emerging countries, or if we look at China and we look at oil, and also if you look at the believing into how these companies were going to generate growth, it's been in the belief that they can expand quick and have a multiples PE ratio and also an expansion, but not really a great increase in earnings. So obviously with these high commodity prices and high oil prices, we're going to see lower profit margins. Not to forget, we're going to see a slowdown in the global economy. So I think that the Asian economy or the Asian stocks are going to go down. But what I would maybe just like to hint is that people always like to compare certain cycles with the past and tend to forget what about now. I mean, if you just go back to 2002, when we also had, a bear market, there wasn't as many hedge fund managers out there. There wasn't as many investors that had access to shorten the market. I really believe that we could see a hype in sentiment of shortening the market. So I think right now we have two themes. We have commodities going up, keep continuing going up, and I believe we're going to see equities going down from a sentiment and a speculative point of view.
And Nico, is it too late then to continue or to get into the commodities train if you're not there yet?
Well, it's always, I mean, we always like also, we throw commodities into one big basket, right? I mean, you should look at each commodity for what it is. If we look at oil, it's a geopolitical tension, is demand and supply. If we look at wheat or we look at soybeans, it's depending on weather. If we look at metals, obviously, if we're going to have an economic slowdown, then metals won't play. So I think it depends. If you play it right, I would say that the entire investment universe shows very many great trends, and there's no reason why you shouldn't be able to make money in this environment.
Okay, Greg, if you look at the commodities sector, then we've talked about how oil really is being supported right now, both speculative point of view and a demand-supply point of view. But if you look at outside the oil universe, within commodities, where do you see opportunity?
Yeah, I think just going back to the point, I think the overall commodity story will continue. We've already talked about oil. I think another interesting play is the gold market. I mean, basically you've got the gold-oil ratio, which is out of sync with historic ratios, and that either is boding for a sell-off in oil or a rally in gold. So we're still fairly bullish on gold. We think, particularly as it's seen as a safe haven in these inflationary times and an alternative to fiat paper. So I think the gold sector is one, but broadly speaking, across the commodity spectrum, if you're looking for diversified exposures, I think that the large cap miners, the likes of BHP, Rio, etc., still relatively cheap from a historical perspective as those commodities prices continue to push up and the earnings upgrades come through. So I think if you're looking for a standout play, it's probably gold, though.
Yeah, but that's predicated on the fact of, I mean, look, if you perceive there that the dollar's going to keep weakening.
That's right.
Yeah, well, there's a lot of people here think the dollar will start strengthening. You know, you've got weakness in the Eurozone. Feeding, if you accept that the Eurozone is at a later stage than the US is ahead, you can see there are arguments for the euro to weaken later in the year if the economy slows down. Can't see anything happening really in Japan. So against those two cross currencies, you would think the dollar has some good chance of strengthening if the US are much further through the slowdown.
Yeah, but I suppose if you look at it as gold just sharply as an alternative to what was or still is, I suppose in some respects, the world's reserve currency, the US dollar, how are the Fed going to get away with raising rates? Are they really going to risk sending the economy into meltdown? I mean, we had
But they don't have to raise rates. We just have to see cutting of rates in weaker economies in Europe and in Japan.
Well, although, the ECB we had yesterday, obviously they're fairly, a tone which suggests they aren't going to be raising rates much more. I mean, I guess, the real quandary is what the central banks are going to do. We've got the Fed, which is really probably in the most difficult position, not being able to raise rates, more likely to cut rather than to raise. We've got the ECB, which has put a rate rise through, but also obviously there's weakness coming through in the Eurozone as well. And then we've got the UK as well. I mean, you need to see the property figures out of the past couple of weeks to see the quandary there. And so I think it's difficult for the central bankers to actually move one way or another. And I think, but in the end, what most will probably choose, as they have through the ages, is choose inflation over growth.
Nick, do you go along with that? And I also wonder, how much more pressure is going to be put on the Asian pegs, currency pegs to the dollar?
Well, that's also one of the questions that everybody, where you have different opinions, both from policymakers and private investors, and where's it going to go? Are we going to, keep letting the RMB go its own way, or are they going to try to make it appreciate, overnight? I think that as for now, policymakers are still standing on the lines. They're looking what's going to happen, where they're going to take the currencies, not only in Asia, but also in the Middle East. They're going to keep pegging the money to the US dollar, and obviously also oil to dollar. I think it's a difficult play right now. I think that's an area right now. I think people keep waiting for where is this crisis that from our point of view, that we are in right now. How long is it going to proceed? What's going to happen? And I clearly believe we need another 6 to 12 months really to see that, from our point of view, that the crisis is going to continue and going to get deeper.
Thank you. Greg, thank you so much for coming in today. Nico Haraji, CEO of N1 Asset Management. Greg Smith, Managing Director at Fat Profits.
Now, talking about banks, UBS is trading at the top of the SMI today after announcing that its second quarter losses will be significantly less than analysts have been predicting.